All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer: nothing in this podcast or any of our other material should be taken as investing advice. Especially today, we're going to be talking about some very volatile stocks. So make sure you do your own work and always consult a professional before making any investment decision. So, with that being said, the topic of today's podcast is going to be the return of meme stocks. So, just last week on May 12th, Keith Gill, aka Roaring Kitty, who you may remember from the original GameStop short squeeze, put out a tweet for the first time in a long time uh, with no caption but just a meme. And the next day, on Monday, May 13th, the price of GameStop skyrocketed, reminiscent to the original short squeeze back in 2021. So, with the fundamental value of these meme stocks so much lower than the trading price of their stocks especially during this past week or two, um, it's potentially an opportunity for some good shorting opportunities, but not without some of its own risks. So today we're going to be talking about some of the pros and cons of shorting meme stocks, and what the risks are to think about, besides the obvious opportunities of shorting stocks that are so obviously overvalued. So with that, I'll kick it over to you, James, to talk about what exactly happened with GameStop last week and what that means for short selling going forward.
Yeah, so to talk about meme stocks, first we have to establish what is a meme stock, because it goes, well beyond just GameStop. There are many meme stocks, and obviously there's no dictionary definition of what is a meme stock. But for the purposes of our analysis here, I've tried to come up with um, a few boxes to check to see whether or not a given stock can be classified as a meme stock. So, firstly, a meme stock is heavily owned by retail investors. The investors are not necessarily bullish on the company's operations. At least that is not their primary motive for buying the stock. The primary goal instead is to push the stock price up. The buying pressure from all these retail investors will push the stock price up, and then they hope to sell their shares at an even higher price. Some of the meme stock traders try to rationalize this by talking about short squeezes. The idea is, like with the original GameStop short squeeze back in 2021, there was indeed a short squeeze. So the idea is the retail investors can pump up the price to a point where the short sellers are forced to cover their positions. And then at that point, the retail investors can sell their shares to the hedge funds, the short sellers who are covering their positions, and that would be basically a transfer of wealth from the hedge funds to the retail investors. So that was the original idea, but over time, it's kind of become clear that in the vast majority of cases, when you are investing in these meme stocks and you're trying to sell it at a higher price, the vast majority of the time you're not selling it to a short covering hedge fund. It's much more likely that you're just selling it to another retail investor, and it becomes somewhat of a zero sum game within the retail investor community. Basically a pump and dump. And we can see, I have here posts from Reddit. The first one is from r/GME, and the second is from r/Wall Street Bets. So this first guy up here says, maintaining buy pressure will soon be more important than ever. They have hammered and suppressed the price for months on end. So don't be fooled into thinking GME isn't as good value now as it was 2 weeks ago. This is all part of their mind tricks to slow the buying. Personally, I'm buying all the way up and will only sell 1 or 2 shares. It's important to maintain maximum pressure on these efforts when they're most vulnerable. So this guy appears to be, buying into the idea that it's the retail investors versus the hedge funds, and their idea is, the retail investors will supply enough buying pressure to catalyze the short squeeze, and then this short squeeze, this mother of all short squeezes that he's predicting, will eventually allow the retail investors to cash out at the expense of the hedge funds. However, this second poster on Wall Street Bets, I think, has a much more realistic view of what's going on. And he says, "Thank God for new suckers." And it's a meme showing, the buff dog saying the previous bag holder, thanking the new members for having released him. And then there's, the much weaker dog, who's the guy who's later in on the game. And he, in a few months from now, why no moon? Why haven't I gone to the moon with my shares? Well, it's because, this whole thing's basically a pump and dump. And then whoever gets in on the ground floor is going to make the profit and dump it onto whoever comes in later. But it's really just retail investors making money off of each other, as opposed to, this idea of going after the hedge funds. Well, based on the evidence, it seems like the vast majority of the rally is caused by just retail investors buying and short selling, and short sellers covering their positions is probably a very small percentage of the trading volume. And the reason I say this is you can look on there's various websites. One is marketbeat.com, which will show you the number of shares sold short for any given stock. And as of April 30th, which is the most recent date we have available, there were 64 million shares of GameStop that were sold short. And there are about 300 million shares of GameStop outstanding. So that means about 20% of the total shares are sold short. So for comparison, back during the original short squeeze in 2021, the short interest was well over 100% of the shares outstanding. So the short interest today, or the short interest, leading up to this most recent meme stock rally in May of 2024, there was a relatively small amount of short interest. So this was not a short squeeze. This was just retail investors getting excited and pumping up the price. So, if you're one of these retail investors who are buying shares of GameStop and then hoping to dump them at a higher price, well, you're going to be dumping it on another retail investor. So it's now basically turned into a zero-sum game among the retail investors. In fact, as we will see shortly, it's actually a negative-sum game because the companies will issue more shares and increase the share count during the meme stock rally, which can have some very negative consequences for the retail investors. And let's go over now specifically some of the price action of the various meme stocks. So it all started with GameStop, which obviously, that's the main one because that's the one that's, most associated with Keith Gill, who catalyzed this entire thing. But there are also many other stocks that, experienced a similar meme rally. And the reason is because these meme stocks, the various meme stocks, they have huge overlap among their investor bases. So if you're one of these retail investors who's long GameStop or interested in GameStop, and then you see this post from Keith Gill, and then it's like, okay, well, that's going to catalyze a big rally. And then you don't necessarily only buy GameStop, you'd also buy all of the other meme stocks because you know that other investors are also going to have that same reaction. So the point I'm trying to make is, all these stocks that are considered to be meme stocks within the retail investor community, they're all going to move somewhat in unison because they're all owned by the same people who are owning them pretty much for the same reasons as meme stocks. So we'll give 3 examples. If you look, there's actually many more meme stocks than just these 3. But for illustrative purposes, let's just focus on 3, which is GameStop, AMC, and Faraday Future with the ticker symbol FFIE, which is an electric vehicle company, which is on the brink of bankruptcy. GameStop increased by a peak of 246% between May 10th and the peak of this most recent rally. AMC increased by 322% to its peak, And then Faraday Future increased much more, all the way up to 8,500%. So an 85 times gain from May 10th to the peak. And we can see that the percentage gain is inversely correlated with the market cap. And the reason that is the case is because when you have the smaller is the market cap, any given volume of buying pressure from the meme stock traders will have a greater impact on the price. Um, the smaller is the market cap. So that's why we saw much bigger gains for AMC and especially Faraday Future, despite the fact that this whole thing was catalyzed by the Keith Gill tweet, and Keith Gill is most associated with GameStop, but GameStop didn't even have the highest percentage gain, and the reason for that is it's because its market cap was much bigger. So that's goes to show that these meme stocks, they're all correlated, and if there's a catalyst for one of them, that's viewed by these traders as a catalyst in general for all meme stocks. It's not specifically tied to one particular stock. But now let's dig a little deeper into Faraday Future, because if we look here, based on our numbers here, our estimate of the market cap was $2 million. And if the market cap was $2 million as of May 10th, it would have had 86% short interest. But as we'll see shortly, it's actually very difficult to understand exactly what is the market cap of Faraday Future. So if you look on Google, Google says that the stock price is at $1.80. And they also say that the market cap is $77 million. So if you divide those two numbers, you would get that Google is telling us that there are 43 million shares outstanding. But this 43 million shares is almost certainly the actual number of shares outstanding of Faraday Future today is almost certainly far greater than 43 million. So it's actually we actually don't know how many shares Faraday Future has outstanding, and the last regulatory filing that they've given was in December 21st, 2023, when they disclosed that they had 126 million shares outstanding, which is a massive increase because they only had 30 million shares outstanding as of September 30th, 2023, which was when they filed, which was from their Q3 Form 10Q. And so that is an increase. They increased their share count by fourfold over the course of just 3 months. So this really shows Faraday Future is in a desperate financial condition. Faraday Future is one of these EV companies that's been a complete failure of a company, and they're burning cash very rapidly, and they're almost out of cash. So they had to massively dilute their shareholders to issuing new shares to try to raise capital to keep the lights on. So we can see massive inflation in the share count. And then on February, so as of December 21st, 2023, they had a separate filing. This was filed after their Form 10Q from 4Q3. They disclosed that they had these 126 million shares outstanding. They had the authorization to issue up to 154 million shares. So they were, getting pretty close to their authorization limit. And, we can see how much they've been diluting thus far. And they were, in a desperate cash situation. So then on February 5th, 2024, they passed a shareholder vote, which allowed them to increase the authorized share count from 154 million all the way up to 1.4 billion. So a massive increase in the authorization. And the fact that they even needed to increase this authorization means that they've probably issued they've probably increased their outstanding share count to well above 154 million That's why they needed to increase the authorization to above that number. So as of um, and then as of February, after February 5th, they probably increased their share count to well above 154 million, but they have not disclosed their outstanding share count since then. So we really don't know for sure. On February 26th, 2024, they released a separate filing where they said that they had paused their at the money equity offering, but they did not disclose how many shares they had issued up to that point. So we know that their share count at that point was somewhere in between 126 million and 1.4 billion. But then they also did a 1-for-3 reverse stock split. So we have to adjust for that by basically dividing the numbers by 3. So we know that their shares outstanding as of today is somewhere in between 42 million and 463 million related. This is all adjusted for the reverse stock split. So it's at a minimum of 42 million, but it's almost certainly way higher than that, given how fast they have been diluting historically, and given that they even felt the need to increase the authorized share count. So now, if we look at if we go back and look at the Google, what they report as the market cap, they are taking the lower bound. So they are only when Google does the market cap, they only look at the most recent regulatory filing, which says exactly what the share count is. So they're taking the number from December 21st, 2023, which was 43 million. But in reality, the share count has almost certainly increased massively, and it could have increased as much as tenfold since then. Right? So, and when we looked at, when we compare, the market cap going into this most recent meme stock rally, if we take that lower bound of 42 million shares, the market cap would have been $2 million, because the share price was, so Faraday Future's share price was about 5 cents on May 10th, which is right before this meme stock rally. If there were 42 million shares, it would have had a $2 million market cap, and the short interest would have been 86%, which would have been, extremely high short interest. But if we take the upper bound of the 463 million shares, the market cap would be $20 million and the short interest would only be 8%. But even if we take that high bound estimate of 463 million shares, the market cap of $20 million is still pretty tiny. And when we look at, the chart of Faraday Future here, this 85 times increase of the share price during this recent meme rally, that even if it was a $20 million market cap and it went up to like a billion market cap, that's certainly something that the meme traders would be able to do, because there's billions of dollars collectively being deployed by thousands, hundreds of thousands of meme traders around the world. And so when you have a small market cap company, be it 2 million or $20 million market cap like Faraday Future, the ability for them to pump up the stock price is absolutely astronomical. So that's something definitely to keep in mind. Now, with that being said, the meme traders are able to pump up the prices of the meme stocks to very high levels, but only for very short periods of time. In the long run, the meme stocks will always collapse back down, and not even necessarily, that much of a long run. Usually, these meme stocks crash very quickly. If we go back to these charts, within days, they started crashing back down. well off their highs. So while the meme stock rallies can be very violent and very astronomical, they are also very ephemeral. And there's a couple of reasons for this. Firstly, whenever most of these meme stock companies are companies whose, fundamental business operations are doing very poorly. So they are typically, or often it is the case that these companies are in need of cash. And what do companies do when they are in need of cash? They dilute their shareholders with equity offerings. And when the meme stock traders pump up the prices of the stocks, that's a perfect opportunity for these companies to issue new shares to raise capital. They're basically just taking advantage of the meme rally. So in the case of AMC, their share count as of May 10th, 2024, which was the Friday before the Keith Gill tweet. Remember, the Keith Gill tweet was on Monday, the 12th. So the share count on May 10th for AMC was 296 million shares. On May 13th, 2024, so that is one day after the Keith Gill tweet, and so really the first day of the meme rally, they announced that they had sold 73 million shares. So right when they saw, the stock price increasing as a result of the Keith Gill tweet, they immediately started selling, huge amounts of new shares to take advantage of the meme rally. And then the next day, they did another. I think this one was actually a debt to equity conversion, but it's effectively similar to an equity raise, where they're going to issue another 23 million shares. So just within 2 days, they increased their share count from 296 million up to 391 million, which is a 32% increase in the share count in just 2 trading days. So you see AMC was really fast about taking advantage of this meme rally. Similarly, GameStop on May 17th, they announced that they had authorized an additional 45 million shares to be sold. But those shares, I believe, have not actually necessarily been sold yet. But they say that they have these shares that they're planning to sell 45 million shares, which would be a 15% increase on their share count. So basically, the point is, right when these meme rallies happen, the companies almost immediately will take advantage of that and issue new shares. Now, if you think about that, from the perspective of the aggregate returns for the retail investors, uh, you know, as the share price is going up, there are some retail investors who are making money, and then as the share price goes back down, as as the rally fades, there's the retail investors are going to be losing money, the ones who are still bag holding. But if at the top of the short squeeze, the companies are massively increasing their share count, well, those shares are going to be purchased mostly by these retail investors, by the meme traders. And so there's basically less shares on the way up and more shares on the way down. So the aggregate basically returns of the meme traders will be negative because more of them will have bought in at the top. Just mechanically, that has to be the case because the share count is increasing at the top. So it's really basically a transfer of wealth from the retail investors to the companies. Then you might say, okay, well, maybe that's not such a bad thing because the companies are now financially stronger, so that will make them be worth more. But AMC and GameStop, their businesses are massively underperforming and are economically efficient. Had it not are economically inefficient, had it not been for these meme stocks rallies, both of these companies probably would already have been bankrupt by now. AMC is losing money. GameStop is also losing money, and its sales are cratering. These are really unviable companies, which are just being propped up by capital that they're extracting from the meme traders. And as we talked about earlier, the short interest of these stocks is actually quite low. So all this money that the companies are raising, that's not the vast majority of it is coming from the retail investors. It's not coming from short. It's not coming from hedge funds that are covering their short positions. The vast majority of that money is coming from the retail meme traders. Another thing that contributes to why these meme rallies typically are short lived is because many of the retail investors will use call options to gain exposure as opposed to just buying the shares outright. And when you are buying a call option, that has a very big impact on the price of the stock. And mechanically, how that works is when you buy a call option, there's some market maker on the other side of the trade who is your counterparty, and that market maker will buy shares of the stock on the open market to basically hedge his negative position of that call option that he sold you. So whenever you're buying a call option, there's some market maker on the other side that is buying shares in the open market to hedge that position. And because the call options can offer such leveraged exposure, the amount of shares that the market maker will purchase to hedge will often be multiples greater than the value that you invested into buying the call option. So for example, if you bought, $10,000 worth of GameStop call options, but that gives you like a massively levered exposure, maybe the market maker on the other side has to buy $50,000 of GameStop to hedge that position, as an example. So that is how, these call options are one of the reasons why these meme stock rallies can be so violent. But on the flip side, the call options have expiry dates by their nature. And especially on platforms like Robinhood, it doesn't even allow you to exercise the call option. If it's in the money, it basically Robinhood will automatically sell that call option for you if it's in the money and just give you the proceeds. Well, when that happens, the position is automatically being closed, and you take your profits, and then that call option no longer exists, and the market maker will then dump those shares that he was keeping as a hedge because the contract no longer exists, so that hedge is no longer needed. So because the retail investors are using call options a lot of the times, when they do make profits, they effectively are closing out their position at the time when the option expires. So therefore, they're not holding it. They're not holding the stock. And then as these call options expire, the buying pressure is removed, and then it's actually replaced by selling pressure as the market makers unwind their positions. And that's why we get such violent crashes after. That's why these meme rallies are characterized by violent increases in price, and then a peak, and then a very violent crash in the price. It's really exacerbated by the call options. And then finally, one point to make is with these, anytime when you have very extreme volatility in any stock, this is, often has a potential for, manipulation or bad actors in the market. And, there's a piece here in Bloomberg, which I think is, very interesting. And according to Bloomberg, traders picked up GameStop options ahead of Keith Gill's Roaring Kitty, his tweet. So GameStop calls had their second busiest day of 2024 on Friday. That's the Friday before Keith Gill made the meme tweet on Sunday, which catalyzed the meme rally on Monday. So that means on the Friday, which was the very first trading day, or on Friday, May 10th, which was the very last trading day before the rally started on Monday, May 13th, there was massive buying of call options. And if you look here at this chart in early May, there's a huge spike in the buying of GameStop call options right before Keith Gill's meme tweet. So why is this the case? Is it a coincidence that you have the second busiest day of call option volume, and it just so happens to be right before Keith Gill makes this tweet? Yeah, maybe it is a coincidence. Who am I to say? I don't know, but it certainly looks very suspicious. And you have to wonder about the motivations of somebody like Keith Gill, who is making this tweet, which maybe he knows that it's going to cause a massive rally in GameStop shares. And maybe he or maybe some people who know him are taking advantage of this by buying these call options ahead of time. And if that's really the case, if they're really, I mean, again, this is speculation. We don't know for sure. It's just the trading volume is very suspicious. But if there are people who somehow knew ahead of time, and they're the ones who are really getting in on the ground floor, well, that just makes it even worse, for the retail investors who are buying into the hype and reactively buying into GameStop after the tweet. That's going to make it, really a bad situation for them. And this is, one of the really big risks if you are, going to be one of these meme stock traders who are just reactively, just seeing whatever meme is out there, and then buying stocks based on that. Well, you could easily become the target of manipulation and pump and dumps. And so that's, a huge thing to keep in mind for anybody who's ever considering wanting to, um, you know, anybody who might be enticed to buy into any of this hype. So as we've talked about, these meme rallies, they're obviously disconnected from the fundamentals, and obviously for the reasons we talked about in this presentation, the meme rallies always end, and the prices always come crashing back down eventually. Well, the problem is if you are maintaining your short position, and then they have another one of these uh, meme rallies, which are basically impossible to predict. None of us could have predicted that Keith Gill would make his tweet, except for those few people who were buying call options. But the vast majority of the public had no idea that Keith Gill was going to make his tweet. So if you are just in the long term shorting these stocks like GameStop and AMC, uh, in the long run, you're probably going to do well because the businesses are overvalued and will eventually, the stock prices will eventually decline. But you could find yourself in a situation where you get a massive rally, and you might get a margin call if your positions are too big. And this is especially problematic for meme stocks because, as we showed, the meme stocks are highly correlated because they have the same investor base. So if you try to diversify across multiple meme stocks, that's not necessarily going to help you a lot because they're all so correlated. If one of them is ripping higher, probably all of them are to varying extents. Meme rallies can happen to stocks even when the short interest is low. So, don't think that because the short interest is low that you're automatically safe because, as we talked about earlier, these meme stocks are driven by the meme rallies are driven by retail investors buying the stock, not so much by short sellers covering. So there doesn't even need to be any short sellers involved, and these meme rallies can still happen. Um, and smaller market cap companies like Faraday Future, basically penny stocks, are the most risky by far because when one of these rallies gets going, they can really pump up percentage wise, they can really pump up the price astronomically because it's starting from such a low base. So overall, while shorting meme stocks does appear to be an attractive opportunity, it's extremely risky. Imagine if you were shorting Faraday Future when it was at 5 cents here, and then it went up to more than $2 and had an 80-fold, or it went up to I think well over $3 at the peak. So it had an 85-fold increase. Well, if you had a short position on Faraday Future in any size, you would almost certainly have gotten margin called. So that's obviously an extremely risky situation to be in. So if you have to short a meme stock, it's much better to short the larger ones like GameStop and AMC because the the potential for a meme rally in percentage terms is going to be much lower. For the stocks like GameStop and AMC and Faraday Future, it's completely irrational. It has nothing to do with the fundamentals of the business. And that adds, another level of risk because these meme rallies are unpredictable and can go almost arbitrarily high. So we think in general, it's a much better idea to short, non-meme companies. And there's tons, as we cover on this channel many times, in many videos, there are tons of companies that we believe are overvalued or fraudulent or basically just crappy companies that are not meme stocks. And we think those are probably the best places to look for short selling opportunities. These meme stocks, while they might look attractive, I think are probably too risky for most people.
I think the only thing that that was going through my mind is the idea that like to your point, not have the possibility of any one short position mooning to like no limit is a really important reason to have many different short positions, right? And have each one of them being only a very very small percentage of your portfolio, and having it so that your portfolio of short positions is diversified in a way that's not the same as diversifying your long positions, right? Like you want them to have different investor bases and um, be in different industries, and not have it so that they'll all just go up just because the broader market is rallying, right? Um, so you don't want them to all be meme stocks, which is one of the reasons why you want to have many different short positions if you're gonna do short selling, rather than having a concentrated portfolio like you would if you were doing longs.
Yeah. And if you're looking for, short positions or potential, short selling opportunities, we have on our website, differentiatedanalytics.com, a wide range of investor resources. One of which is our original short selling research, where we write detailed reports on companies that we have bearish views on. And we don't focus on meme stocks in these reports. We focus on other short selling opportunities that we believe to be less risky. But there's obviously always risk in short selling or any investing for that matter. But if you're interested in gaining access to our original short selling research, as well as a wide range of other investor resources, you can sign up for a premium membership to differentiatedanalytics.com, link in the description below. And if you use the discount code WSM50 at checkout, you will lock in a 50% discount on your subscription. So with that being said, I think that's about all we had for today's video. If you have any thoughts on GameStop or the most recent meme rally, please let us know in the comments section below. And we will see you all on next week's video.